This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of August 21st, 2026. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. And we'll remind you right off the hop for wealth and wealth management to start your investment journey, or maybe to have a different eye on it. You can reach out to Patrick anytime. All of his contact information is at www.patrickmleonard.com. So go there and get in touch with Patrick for all the expertise and all of the questions that you have. Well, Patrick, we usually start the podcast off looking at the markets, and it has been a tumultuous 5 days, that's for sure, especially the last 24, 48 hours here as we approach midweek.
Yeah, going into this week, expectations were that it was going to be quiet. We don't have any big releases of financial data on our calendar, and we have largely passed through the peak of earnings season in the U.S. We do get the Canadian banks next week. So that will be that'll be important data for the Canadian market, but relatively quiet. And so sometimes when you get a vacuum with regards to new information, is that if there isn't something that is a catalyst to drive the markets higher, is that you can see the market maybe focusing on some of the negative things that are out there. And so when we take a look at just how kind of our big board indices have kind of performed, both the TSX and S&P 500 are both down modestly since our last podcast, down today, and U.S. market's down about 75 basis points for the week. Canada's down about 50 basis points for the week. So oil, with oil prices going up, that certainly isn't going to be something that the market's going to be overly positive. And today it's up about $3. On the positive side, though, the Western Canadian Select differential has narrowed a little bit. So WTI at 85, Western Canadian Select at 72. So we've got a differential of about 13. So that's a better number for Canadian energy exporters. And then gold is kind of held in there at around $4,400 US an ounce. Bitcoin is kind of stabilized around 64,800. An interesting point is that I think it was 2 weeks ago we had a slightly negative U.S. jobs report, and we could actually draw a positive out of that for people that are hoping that the U.S. Federal Reserve doesn't have to raise interest rates due to higher inflation. And so we've actually seen the U.S. dollar weaken a little bit on that news. And I would say that, for the most part, is that we're kind of welcoming that. Going back to December, our forecast was for the U.S. dollar to weaken versus a basket of other global currencies. And in fact, we got the opposite. The U.S. dollar strengthened against most other currencies. So with that U.S. dollar weakening and most globally traded commodities trade in U.S. dollars, is that you do get a lift in some of those asset prices. And so things like certainly oil, metals, agriculture products, etc., but also gold and Bitcoin, would benefit from a slightly weaker U.S. dollar. So next week, Canadian banks will give us some earnings, and so that would be kind of definitely something for us to look forward to.
We are year to date up on the S&P TSX composite around just shy of 15%. If you go year to year, you're at 30%. Would this, be categorized as a bull market?
Oh, for sure. And our belief is that the S&P 500 is still kind of maybe only in the midpoint of a secular long-term bull market. And as we were preparing for the podcast today, I was saying, this is kind of one of the most kind of hated bull markets.
Why? Is it because of people who are skeptical about things that the people think, oh, it's going to end and everything's going to fall apart? Or is it on the other flip side of that? Is it people who are just so overly optimistic? They think it's just going to last forever. What does it all mean?
Yeah, Terry, I think you framed it right. I think you've got kind of a balance. You've got these, two kind of opposing forces where you have strong fundamentals, which is driving the markets. And so, we kind of saw that through U.S. earnings season is that, for the most part, is that we saw, earnings for the last quarter, year over year, showing about a 20%, average growth in earnings, from last year, which is phenomenal. And also, most of these businesses provided good guidance, which we talked about last week. And so you have some strong fundamentals, but then you've got all these other macro conditions in place that are really hard for people not to focus on. So we get obviously lots of information about what's going on in the Middle East. We're still all very concerned and saddened by what's happening in the Ukraine with Russia. There's always kind of this fear in the background about China and Taiwan at some point in the future. Canada and the United States, going back and forth to, try to create a new deal for trade. So tariffs are obviously something concerning. So you have these concerns in the background, which investors take a look at, but then you have the market doing very, very well above its long-term average. And so I think it leaves investors, at least some investors, really kind of torn about what they should do. And so this is where this probably some angst comes from. And so it's kind of a Wall Street idiom when they say it's kind of a hated bull market, is just because there's so many skeptics out there. But I think what would be healthy is that if we even saw a correction, and the market were to come down for a brief period of time, and then see some new money come back to work, adding to some stocks for businesses, good quality businesses that investors then felt maybe more comfortable about adding money to at maybe that lower price. And so sometimes like a healthy correction, when you've had a really strong run in the market, is not such a bad thing. And we've kind of talked about that may be something that is in our near-term future, because in years where you have a midterm election cycle in the United States, is that historically, you've got a period of time in the months running up to the midterms where the markets are weak. So be careful what you wish for.
I suppose, and then there's the other thing too. Is everybody asks Warren Buffett how he got so rich? He says because he sold too soon. So, when you're in a bull market sort of situation, when do you get out? When do you jump in? When when the house is on fire, the firefighters are running toward it,
Yeah.
but most people are running away from it. And it's the same with investing. And really, the market, everything is all speculative to a certain degree as well. And there's the thing where people have FOMO, fear of missing out. So, how cautious should we be on speculative investments, in maybe more specifically than broader and in general?
Yeah. I think that probably the fear of missing out trade is its most dangerous when the markets have gone on a very long, sustained rise. Is that strong performance has perhaps brought some fence sitters into the mix, and And so you maybe have people looking for ways to add more of their capital in, because maybe this market has convinced them that if they don't get into this market now, they are going to miss out on this grand opportunity. And on the flip side, you could have people that are saying, you know what, I've really missed out on maybe the core of investing in those large cap Canadian stocks or US stocks. So now I'm going to decide to invest my capital on some of these fringe names in the market. And maybe those are penny stocks, or maybe there's some of these kind of businesses that are constant themes in the market. So the Mag 7 stocks, or perhaps it's because of an IPO like SpaceX, is that now this has been the catalyst that gets the sideliners really interested in getting into the market. And then they feel like they have to catch up on that trade. So perhaps they're taking more risk than they should. And so, as a portfolio manager, investment advisor, we field these questions from clients, and they'll say, I have this idea. I feel like I should invest in this, and maybe it's because my friend told me I should invest in this. And so it's really important for us to kind of back up the bus and say, where does this new investment fit, within your plan? Does this investment fit within your risk tolerance? Does the timeline for this investment, where you may see a temporary drawdown in your capital or a permanent drawdown in your capital for putting that money to work, is can your financial plan sustain that loss? And so I think that it becomes more dangerous. And then the added part of this fear of missing out trade is, where's the client getting this money from? Where's the investor getting this money from? And so often what you see people borrowing to invest. So much safer to make those, regular commitments to saving and investing throughout the course of the year. But I do think that when you see the big run up in the market and people think that they've kind of missed out and now they have to jump in, so maybe they're going and borrowing on a credit line. And so now they're investing with really money that they don't have and counting on those returns to pay for that investment. And so I think, again, taking a step back, how does this investment fit into your long-term plan? Do you have the timeline, which usually is required? A longer timeline is required for called riskier assets. And I think probably it's that, taking that deep breath and assessing where this investment fits, probably for most people will answer the question is this an investment I should make? Or should I just kind of stick with what's worked for me in the past with my plan, within my risk tolerance, within my time frame, within my detailed financial plan?
Do you have Apple TV? Have you watched the miniseries or the TV series called Stick with Owen Wilson?
Is this where he's the golf pro?
He's the washed up golf pro that ends up coaching a young kid named Santiago, and Santiago's mom has $100,000 and she wants to put it all in helium. I mean, on paper and verbally, it sounds pretty good, but diversify. Pork bellies, Mortimer.
Yeah. Trading Places, one of my favorite movies. Yeah. Yeah.
There you go. That's the Wealth Roundup for the week of August 21st, 2026 with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. And a reminder to find out all of his contact info at www.patrickmleonard.com if you want to get your wealth management all gathered up and looking nifty. Start your investment journey with Patrick Leonard at the Leonard Wealth Advisory Group. Thanks very much. Have a great weekend, Patrick.
Thanks, Terry. You too.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.